about GFC, Great Financial Crisis. So like we said earlier, banks create financial products and they sell them to large financial institutions, hedge funds, sovereign wealth funds, large asset managers, family offices, etc. So this is going to lead to what Sergey called securitization 2.0. Okay. And securitization 1.0 is what led to the Great Financial Crisis. You had these investment banks grabbing these, creating what's called mortgage-backed securities. And essentially what they were there were multiple tiers of mortgages, and the tiers were based on the risk of default. And they thought that if you put mortgages where people had a high likelihood of paying back with people with not as high a likelihood and people with a super low likelihood, they thought that they were diversifying their risk, and they thought that it was a safe investment. But once the Federal Reserve raised interest rates, everything went to shit.
And so part of that, by the way, it was because it was more subprime lending than was warranted and or wanted. And obviously that wasn't realized till later. And so when it came to putting those MBSs in a package, a lot of, especially non-banks, smaller banks, they would be putting a bunch of tracks together. So it wouldn't even be tranched out properly. It would just be literally like 60% subprime or probably more. And so when those losses took place, when interest rates rose and people could no longer afford their monthly payments, the hit was actually exacerbated more than it would have been if it was actually a properly tiered basket of mortgages. But it wasn't properly tiered.
Indubitably. And the thing is, and this is what ChainLink is going to solve, or CCIP is going to solve, what oracles are going to solve, is people will be able to better assess the risk. So banks are going to get to generate large amounts of assets, put them on chain, like literally anything that they want to tokenize, they're going to be able to put them on chain. Like this is what banks do. They create these financial products and they'll be able to sell them to a global, not just domestic market, and in the end, make more money, which is their profit motive. So this can work with oracles because they're going to be able to offer more transparency and allow investors to better assess the risk of bad information, missing information, and information around the underlying asset, which we didn't have in the GFC.
So if, for example, if you were trying to sell me a basket of mortgages or mortgage-backed securities, right, I would be able to see before I buy those basket of mortgages, the makeup of that actual basket with something like CCIP and Oracle networks working together. I would actually be able to see what percentage I would consider subprime if you have somehow a different definition, because you know some banks are weird and they try to change the definition of certain things or whatnot. But I would be able to tell which percentage are subprime, which percentage are high quality borrowers, which percentage is a mid-tier or preferred, right? And from that point, I would actually be able to make a decision. So now those losses that you have unrealized on your books, it doesn't become systemically a risk. It's actually, I'm still inoculated because I know what I own, quality mortgage-backed securities, and now I can see what you own. So now I know not to buy from you and add those unrealized losses to my books. You know, so there is no more hot potato with something like that. And so I will be able to tell instantly before I make that purchase. So it makes those transactions and counterparty risk way more secure.
Good stuff, man. Yeah. So that's a perfect segue into, let's talk about how, if oracles were around and, you know, companies were on chain during the GFC, how it could have prevented the GFC. So imagine if every mortgage holder had their own smart contract that represented them individually, right? And every time they got a mortgage, or
so we're talking about already fully established,
fully established, built out, like 5 years
cool.
from now, back in 07, or 10 years from now, whenever, however long it would take.
Okay, so we got to paint this scenario properly. So when is this implemented? Is this implemented in 2003, 2000, 2006? Because that changes things. It really does.
I guess before they started doing the whole mortgage, before they start securitizing mortgages.
Okay, let's say right after the dot-com, so 2002.
Okay, so 2002, this is around. And let's say every mortgage holder has their own smart contract. Let me explain what a smart contract is. Smart contracts effectively do three things at a very basic level. They store rules, they verify rules, and they execute functions based on those rules. And a good analogy of a smart contract is a vending machine. When you go to a vending machine, the storing of rules is knowing that V6 is a bag of Doritos. The verifying of rules is knowing that once you put $1 in, that the dollar is real. And then the executing function based on those rules is when you click V6, the ring spins around, and now you have your bag of Doritos. That's exactly how smart contracts work on chain. They're
so it's
programmable.
if-then.
Yeah, if then you can program it to do whatever you want based on memory of data and things that you can do with that data.
Yeah, I would just add that it's black and white. So if this happened, then this happens. And if that function isn't executed, the contract won't disperse funds or do whatever the end goal is.
Yeah, and
if that function isn't executed.
This is why people are saying that smart contracts can replace intermediaries, because if you are trying to do a transaction and you have a smart contract that says, once said party gives me the money and said party gives the product, they will get dispersed. So if one person puts the product there and another person tries to get it without putting the money, you can put like a timer on the smart contract and the product will go back to the person. No one can get fucked over. So
exactly.
And
that's great for companies who work on like a net 30 basis as well, in which their payment is delayed. So yeah, that's a great function to have in your business.
Yeah, we're going to see smart contracts evolve over the years. So imagine if every mortgage holder had a smart contract that represented them individually, and every time they got a mortgage, the smart contract was updated. Every time their credit score went up or down, their smart contract updated. Every time their bank account stopped getting paychecks, the smart contract would be updated. If that level of clarity was provided with what was packaged in these mortgages, crisis averted.
Well, those people wouldn't have got approved in the first place. They wouldn't have had a home. Yeah.
Exactly. Which wouldn't have allowed them to
but
be
let's say
packaged.
even go ahead.
But let's say even if they were packaging it, but and you know, they were still somehow able to, because the value is always understood and not just by the entity that created it. Because what happens is you have an investment bank that created it, they sell it to a hedge fund, that hedge fund sells it to a sovereign wealth fund, that sovereign wealth fund sells it to another hedge fund, and now the value gets lost because they're just, it's like playing hot potato, you know. So imagine playing hot potato and then you have a tracker on the temperature, so you know when things are about to bust, so you can say, oh, I don't want to buy this because of that, not just
right. And you know, a lot of institutions had, like, they knew that banks and non-banks were transferring toxic assets. So once again, that goes back to the earlier example. It's like if I'm Bear Stearns and you're someone else, JP Morgan or Bank of America, and I'm trying to sell you some toxic asset for liquidity purposes, well, you're going to know upfront. You're going to know before that transaction takes place, like, these wouldn't be good to hold, especially given where monetary policy is right now. It wouldn't be good for us. I can see us going under just for that. That simple aspect right there, it eliminates systemic risk. That was there because they were playing hot potato with horrible assets, with horrible quality borrowers. So yeah, even if, you know, the Oracle network and CCIP was implemented after like the biggest run up of subprime lending, it would still mitigate the effects of the disaster that took place 100%.